What's up, everyone? Welcome to the daily macro update for Tuesday, November 18th. Taking a look at the macro data for today, we had the New York Fed Services Activity Index have a pretty decent drop. This index has been pretty much in a bearish type of environment for the past several months. And so it is showing that growth in certain parts of the economy are not doing so well. And the services sector is something that we need to pay more attention to, other than the manufacturing sector, excuse me, because the services sector makes up the majority of the type of activity in GDP, and manufacturing makes up a smaller part of that. So services in the United States are what to look at. And when taking a look at this graph, let me zoom out a little bit here. When taking a look at this graph here, you can see ever since 2025 began, it's really been a pretty decent deceleration within the services sector. It was recovering a little bit coming out of 2024, but since 2025 began, it has been a pretty large decline. So that continues to be a headwind. Now, this is only looking at, I believe, Connecticut, New Jersey, New York, and I believe Pennsylvania. Yeah, so New York State, New Jersey, and Connecticut. So it's not the entire country, but this is one of the more larger areas to take a look at. And yeah, we're continuing to see a deceleration there. We also saw the weekly ADP jobs update. The ADP over the past couple weeks has been supplying this number on a weekly basis, and that's an average of the past 4 weeks. And so in taking a look at that number here, it did have still a negative number, but it wasn't as bad as the previous week. What we need to be looking at in this, with this metric as we get more data points, is that where the trends are going, right? So with it continuously being negative back-to-back weeks, that's not the best news for the labor market. Home builder sentiment, so new homes, continued to increase here. And so if we take a look at the NAHB housing market index, that actually had an acceleration in November. And so this is a lot larger from the lows that we saw from May all the way until September. And this is a little bit more of an optimism for rates coming down, although it seems as though we might see a rate pause coming up here. This housing market index is pretty lagging, so it's not something to be looking at in terms of forecasting. But, it is interesting seeing the optimism continue there. Taking a look at the target rate probabilities for the Fed meeting coming up in a few short weeks on December 10th. This remains at a coin toss, a 50-50 split between pausing as well as cutting by 25 basis points. Now, this is a little bit more of a shift towards cutting by 25 basis points, as yesterday this was at a 42% chance, and so that rose to 51%. So that is a point scored for the people who want a 25 basis point cut. But really, if you look at the previous 1 month change, Remy the cat just stopped by. Remy, get your tail out of the screen, bro. here's the Remy. Here's the Rems. It's getting close to his feeding time, so he always gets a little riled up. But anyway, getting back to this here, it is interesting though how close we are to this Fed meeting, and the futures market still is unsure which way the direction is going to go. And this is just showing that the Fed governors aren't giving a clear direction or consensus. And that uncertainty is something that the market is clearly not liking. So we'll continue to see how this plays out as we get closer. But really, I can't remember the last time that we got this close to a Fed meeting and there wasn't a pretty much consensus on the direction of where the Fed is going to go. And so if this continues to be a 50-50 split heading into the meeting, then I wouldn't be surprised if you saw continued uncertainty going into the meeting there. So yeah, pretty interesting stuff there. Inflation expectations remain around 3%. We still need to get the CPI data. Hopefully we'll get that, I believe, on, let me see. We won't get that this week. I guess they're just going to push that until December. So we still have a few weeks before we see that. Let me just take a look here. Okay, it looks like they're going to try and do PPI on Tuesday. And then we get core PCE next Wednesday. And then on Thursday and Friday, the markets are closed for Thanksgiving, as well as the day after Thanksgiving, Black Friday. So yeah, and then the week following after that, okay, they're still not producing CPI. Okay, well, I guess they're just going to wait until the second week in December to produce that, which that will be a pretty crazy week. Not only will we get the December 10th meeting, but then also, too, we'll get the CPI print. So, you know, this year is not out of the woods yet for craziness. So we'll continue to monitor this. Now, the title of this video is that healthcare is remaining bullish in a sea of redness across the board here. And so what I'll do is, this is Berkshire, which is also bullish, which, you know, Berkshire has been more defensive with their allocations. So it's no surprising that this stock has actually been continuing to outperform as things get a little bit more risk off. But when taking a look at healthcare, look at this. The healthcare sector just remains one of the biggest bull markets so far at the end of the year here. So the concentration in healthcare, as well as we're getting a little bit of a bull market in energy right now. XLE, the energy ETF, since mid-November, or I'm sorry, October, is up over 6%. As well as you have utilities, which that's up as well, but it's been consolidating here. And it looks like it's about to push upward more if we get more of a stagflationary type of environment. I'd be looking at utilities as well as gold and silver to start to regain some strength here. But the biggest losers today, tech as well as consumer discretionary. Tech still remains bullish, but it's hanging on by a thread there. And so as of right now, the bookshelf behind me remains green in a bullish trend, but that could change. So we need to definitely monitor that. It's right on the edge there. So that with volatility starting to spike up, you know, volatility continues to creep upward towards, 30. I wouldn't be surprised if the S&P 500 index ETF SPY goes bearish in our model. But we'll see what happens there. Things are pretty oversold though. And we're also getting the VIX over 3-month VIX ratio around 1. So I actually wouldn't be surprised if we had a bounce from here on a lot of things that have gone down over the past several days. So things like some of the mega caps as well as the SPY, all of which are near the low of the trading range right now. If I just bring up the SPY here and bring up the trading ranges, You can see that currently it's near the low end of the trading range on accelerating volume, as well as accelerating volatility. So not the best signs. This would need to break down and close below 653 in order for it to break trend. And so it's not quite there yet, but I really wouldn't be surprised if we did have a bounce from here. So seeing something like this. Now, if we do see a bounce from here, what's important to notice is the context in which we have the bounce. Is that bounce on lower volume with accelerating volatility? That's what we want to be looking for. So, yeah, I mean, I wouldn't be panic selling. Now, this isn't financial advice, of course, but I wouldn't be panic selling things that are down unless they're, unless they're getting absolutely smoked and have a way worse trend than the S&P 500 here. But yeah, I just wouldn't be surprised if we had a bounce here soon. Which, if we do get a bounce on lower volume, that would provide a great opportunity to consolidate on things that may have stopped making you money in your portfolio, or just completely get rid of things that have broken trend. So that is what I'm seeing there. Bitcoin tried to have a bounce today. Not really. I wouldn't be surprised if Bitcoin has a bounce as well at some point, but we're just not seeing that here just yet. Dollar remains in bullish trend. That's being a huge headwind on things right now. A bullish dollar typically wreaks havoc across equity markets. So we got that going on. We also have bond yields starting to come down a little bit on the lower end. We had the 2-year yield drop back down a little bit here today. They're still remaining kind of near the top end of the trading range. So we'll see what happens. Today was definitely more of a growth and inflation scare day, which the market kind of liked. But we'll see what happens from here. The volatility index being at 24, it's about to close here in 3 minutes or at around 24. That's not what you want to see if you're trying to like take risks on equity markets. So that's what I'm seeing here today. But yeah, healthcare, as well as if I want to bring up a couple of the most bullish trends right now. Let me see here. Yeah, so probably the industry with the best trend right now is actually biotech. So biotechnology, the ticker here is IBB. Look at this bull market. Bam. Now that's way better of a trend than a lot of people, than of things that a lot of people are, hyper focused on. That as well as pharmaceuticals. So the pharmaceutical industry right now, you can look at ETFs like IHE. These are incorporated in the healthcare sector, ETF XLV, but honing in on pharmaceuticals, that's where a lot of the juice is coming from. So biotech as well as pharmaceuticals, those are the companies that are doing the best right now. So there are bullish trends out there, ladies and gentlemen. You just have to make sure that you're paying attention to where they're at. And all you want to do is own bullish trends. There's ways to make money still. That's why macroeconomics is so important, because it opens your eyes to these different markets so that it broadens your scope of what you can invest in other than just QQQs and Bitcoin. You don't have to just own those. And that's what macro optics does, or macroeconomics does. We do that too. We help people have a strategy on macroeconomics, which if you guys are interested in learning more about that, we still have a few spots left in our 6-week macro mastery challenge, where we go over our entire process. We go into a lot of the, technical things that we talk about, more of the macro language, as well as how to apply that to make money in the markets, how to risk manage your portfolio. So there's the knowledge, but also the application. We're helping you do both in there. And even if you're someone who trades options, even if you're someone who's a day trader, even if you're somebody who's just a long-term investor, macroeconomics applies to all of them. And so it's meant to give you the highest probabilities with whatever you're doing. Right? So let's say you just own things for the long term, own things that are in bullish trend. Let's say you're an options trader. Well, own things that, buy calls on things that are going to have a high probability of continuing higher over the next few months. So that's what we're doing in the group there. Just use the link in the description below, and you can book a time with me and we can review everything. Pretty short show here today. It's a little bit boring out there, but, still important to cover a lot of these different things. So let's go ahead and get into some of the questions here. I've been busy in the group. That's why I haven't been posting too many short videos on my Instagram as well as TikTok page. So I'll try and get to some of those edits tonight. I still am looking for an editor who can help me out and knows the financial markets. If you edit videos, all I really need help with is clipping these things. It's not even that hard. I just don't have the time to do everything here. So if you can clip videos, let me know. Definitely need help with that. But let's go ahead and go over to Instagram here. Appreciate everyone for joining. If you guys appreciate this macro content, consider subscribing to the YouTube channel, sharing our videos with a friend or a family member. And that would help us out as well as the algorithm. Great videos. Reminds me of when I was going for my econ PhD. Appreciate it. Appreciate the compliment there. I do not have a PhD in economics. I don't even have a bachelor's. I'm a mechanical engineer. ETH and alts hold more than Bitcoin, so it's kind of alt season. What? Absolutely not. Ethereum, altcoins, no. The only thing that's doing well is Zcash in terms of altcoins, and maybe Dash. But yeah, a lot of the privacy coins, but no. Ethereum, Solana, all of them remain in a deep bearish trend. It is absolutely not altcoin season. It's not any season when it comes to crypto. It's sell season. You haven't found IA tools to edit video? I have, but they're still not good. I mean, say all you want about AI, there's still a lot of issues with it, and it's not perfect. Can you take a look at the Brazil ETF EWZ? Sure. It's bullish trend currently. It's not near the low end of the trading range though, but getting close. That's what you want to see, some declining volume as the price declines to the low end of the trading range. It's definitely getting there. The market is boring because everyone is waiting on NVIDIA earnings tomorrow. Yeah, possibly. That'll be a fun update tomorrow because we'll see the reaction of the market there post NVIDIA earnings. Dardos says diamond hands? Absolutely not. Diamond hands makes you broke hands. If you're diamond handing cryptocurrencies right now, well, you're going to be asking for a handout pretty soon. I'm seeing analysts talk about quantitative easing within the next 2 to 3 Fed meetings. Thoughts? How do they know that? What do they see the future? What do they have, a crystal ball? At some point, the Fed is going to have to expand their balance sheet. There's no question about it. But if you're trying to guess when that happens, you're just guessing. You know, things would have to get pretty bad for them to really accelerate it. It's just the rate of change of how they do it. The quantitative easing that everyone thinks is when they just flood the markets because something is breaking. When they start to add assets back on their balance sheet, you always have to look at the quality of assets that they're adding. Because beforehand, when they were doing QE, they were adding longer duration bonds. So like 10-year, 20-year, 30-year bonds, as well as mortgage-backed securities. Right? So not only were they flooding the market with, flooding the market with liquidity, but they were also reducing a lot of the risk in the public markets. So it serves as two features there. And so with what they're doing right now, which is ending QT, maintaining the same levels, starting on December 1st here, they are essentially just maintaining the same reserve levels, but also offloading risk to the public markets because they are adding shorter duration bills. They're taking a lot of the principal from the maturing mortgage-backed securities and then buying bills with that. So, yeah, I mean, we'll see if QE happens. The thing is that, and what a lot of people don't understand, and I feel like I just keep repeating this, but in the event where the Fed has to come back and do emergency QE, what typically happens? Markets are pretty much crashing at that point. And so for people who are buying Bitcoin ahead of QE, I don't know why they're doing that. Because as it's happening, Bitcoin crashes first, the stock market crashes first, and then the Fed has to react with then doing QE. And then after the fact, after the market already went down a bunch of percentages, stock market goes down 20%, Bitcoin goes down 35 to 40%. After the damage is already done and people lost their butt, then the Fed comes in with QE. And so with that logic, you would wait until after QE is already commenced and the Fed already announced all of this. It's after the fact, after the damage is already done and the dust settles. That's when you want to get excited. But no, if you're buying before the Fed does QE, that's not how it works historically. The Fed would never run and begin QE in anticipation of a weaker economy. No, because what's inflation doing? Inflation's at 3%. They wouldn't risk that. They're going to wait to see actual data of disinflation, which means they're always going to be late. And if you don't believe me, just look at history. That's what they've done every single time. The dual mandate that the Fed has, it's always butting heads with itself. A good economy, as well as keeping inflation down, that doesn't work when you're getting to the later stages of the business cycle, which is where we're at right now. Does that make sense? So no, the Fed, no matter how many talking heads get on TV and tell you otherwise, if you just look at history and look at what the Fed looks at and see what actually causes them to make policy changes, it's always after the fact, once they receive hard data, which is always lagging. This data only comes out once a month. So, yeah, the Fed is a reactionary force. It is not a precautionary or preemptive force. So, yeah, Hopefully that clears it up. If you don't have to take my word for it. Just go back and look at history. Maybe we can actually bring up an example here. Let's take a look at Bitcoin, since Bitcoin's on everyone's mind. Let's go all the way back to the pandemic. All right, so here's the pandemic. Let's see. The Federal Reserve started its QE program on March 15th of 2020. There you go. What happened before they started on March 15th? Bitcoin down 53%. What did Bitcoin do as soon as the Fed started QE? Would you have been better to buy Bitcoin before QE or after QE? Leave a comment below. Let's do the S&P 500. And let's go back to 2008. What's your view on MicroStrategy? Bearish. All right, going back to the great financial crisis here. The Fed announced on November 25th that it would start QE. November 25th, 2008. So that is right here. So in the 2008 example, there was a little bit more of a drawdown even after the fact. So not all QE initiations are created equal. Not all QE beginnings result in an immediate V-shaped recovery, just like in 2008. But again, what happened if you were to buy the S&P 500 dip before they did QE? Let's say you bought it just a few months before. You would have suffered a 32% decline in your money if you were to buy the already, let's see, from the highs at that point, a 19% dip in the S&P 500. I'm sure they were talking about it back then. You would have suffered an additional 30% loss if you were to try and buy before the Fed did QE. So wait for the announcement. Don't try and anticipate it yourself. Even when they announce QE for the first time, still pay attention to what the trend is in the markets. Don't just automatically go out and buy stuff. Hopefully that makes sense. I'm out of the market myself, just waiting to deploy my money. Why are you out of the market? There's plenty of markets that are in bullish trend. Healthcare, biotech, pharmaceuticals, all those markets are way bullish right now. So there's no reason to be completely out of the markets. Do you know Gareth Soloway? No, I don't. We are still in stealth QE? No, we're not. The RRP is completely drained. That's why the market has been struggling so much, because the fake QE is over. People don't realize that ever since 2023, we've been dumping trillions of dollars from the reverse repo facility in the markets. There's already been QE going for the past 3 years. This is the first time since 2022 where there's really no stealth QE going on, or any QE at all for that matter, you know? So that's why the markets are very tight. But good questions there. All right, it's 4:15. We're going to go ahead and call it there. Appreciate everyone for joining. And yeah, we will catch you in tomorrow's daily macro update. Bye, everyone.